Welcome to the Deep Dive. We're the show that, cuts through all the noise, all the data, and tries to give you the really important insights.
Absolutely. And in today's business world, things move so fast. It's tough just keeping up with the headlines, let alone understanding what's really going on under the hood with a company.
Exactly. We know you want to be properly informed, but who has time to wade through hundreds of pages of financial reports? That's what we're here for.
So our mission today is to do a deep dive into Informa PLC's 2025 half-year results. They just came out, published July 23rd, 2025.
And it's a really interesting one. Informa is this big player navigating, both the traditional B2B event space and the whole digital services world.
That's right. We're going to unpack the key takeaways from their report. Not just the numbers, but the strategy, the challenges, what it all means.
Our goal is simple. Give you a shortcut to understanding Informa's health right now, where they're heading, and maybe even what it tells us about the broader B2B market. So we'll look at the financials, their big plans, even the risks they're watching. You should walk away feeling like you've got a much clearer picture.
Okay, so let's jump right in. The first thing that hits you when you look at these H1 2025 results is just, wow, the growth.
Yeah, it's pretty stark. Their group chief executive, Stephen A. Carter, he actually said Informa is further increasing the pace of performance. Strong words.
And he backed it up. He talked about 20% plus growth in our four key performance measures. That's revenues, profits, earnings, and free cash flow.
20% plus across the board.
Yeah.
That's significant.
It really is. It's not just a small bump. It signals, real momentum.
Okay, so let's put some actual figures on that. Reported revenue, up 20.1%. That takes it to just over £2 billion, 2,035.9 million.
And adjusted operating profit climbed 24% to 578.9 million.
Then there's adjusted diluted earnings per share, basically profit per share. That jumped 25.2% to 29.8 pence.
And don't forget free cash flow. That grew 25% to 356.9 million. So like we said, strong numbers all around on the surface.
Right, but you mentioned reported figures. There's always this distinction, isn't there, between reported and what is it? Underlying growth.
Exactly. And it's a really important distinction. Reported growth includes everything: acquisitions they made, businesses they sold, currency swings, all that stuff.
Okay.
Underlying growth strips all that away. It tries to show you how the core existing business performed organically. It's a cleaner measure, really.
Gotcha. So what did the underlying figures look like for Informa?
Still very healthy. Underlying revenues grew 7.8%, and underlying adjusted operating profit was up 9.2% in the first half.
Okay, so even without the acquisitions and currency effects, the core engine is still humming along nicely, about 8–9% growth.
Precisely. It shows genuine business health, not just growth bought through M&A or helped by currency tailwinds.
So looking ahead then, how confident are they feeling? Does this strong performance translate into future outlook?
It seems so. They talk a lot about their strong forward visibility, which basically means they have a good idea of revenue coming down the pipeline.
How good?
Well, they say about £3.1 billion, which is roughly 80% of their expected 2025 revenue, is already committed or visible. That's things like subscriptions, event bookings already made, contracts signed.
80% visibility for the rest of the year already locked in. That's quite something.
It is. And it's up from £2.7 billion at this point last year. Plus, they've already got over £500 million booked for 2026. That's up about 15% compared to the same time last year, looking ahead to 25.
So that confidence is translating into their forecasts too.
Yes. They've actually upgraded their full-year guidance for 2025. They now expect group underlying revenue growth to be around 6%, maybe a touch more or less. That's up from the 5% plus they guided before.
Okay, and margins. Are they squeezing more profit out?
Margins are up too. Adjusted operating margin increased to 28.4%, up from 27.5% last year. And interestingly, they mentioned that some AI data licensing agreements helped underpin that margin improvement. We can maybe circle back to that.
AI data licensing. Intriguing. Okay, definitely something to unpack later. So strong headline growth, solid underlying performance, good visibility, and upgraded guidance. Seems like a positive picture overall.
Broadly, yes. But like any large company, the picture gets more nuanced when you look at the different parts of the business.
Right. Let's do that. Let's peel back the layers. Where should we start? Maybe the live B2B events. That seems like a core part of Informa.
Good place to start. And it's performing very well. They reported continuing strong growth here, 8.5% underlying revenue growth in the first half.
8.5%. So the return to physical events is still going strong. Where are they seeing particular success?
Across a real mix, actually. They highlighted healthcare events like WHX, construction with World of Concrete, private capital with Super Return, and even marketing with Ken Lau.
Wow, quite diverse.
And a key strength seems to be their geographic spread. They're pushing into faster growth regions, India, Vietnam, Indonesia, Saudi Arabia, the UAE. They just launched Money 2020 Middle East in Riyadh, for example.
So that diversification helps protect them if one market slows down.
Exactly. It builds resilience. Based on this performance, they've bumped up the full-year underlying revenue growth target for this division, specifically to 8% plus.
Okay, so live events are firing on all cylinders. What about their academic markets division, Taylor and Francis? How's that looking?
Also very strong. Further strong growth is the phrase they used. Underlying revenue up 11.9% in the first half.
Almost 12%. In academic publishing, what's driving that? Is it just subscriptions?
Subscriptions are definitely a big part, strong renewals there, but also expansion in open research, where research is freely available, and there's ongoing demand for their specialist data and content archives.
Right, makes sense.
But here's where it gets interesting, again, connecting back to that AI point earlier. They mentioned deepening relationships with AI companies.
How so? For using AI internally?
Well, yes, partly for efficiency, but also for further data licensing agreements. Remember those deals we mentioned boosting margins? They generated over $75 million in non-recurring revenue in 2024, and they've signed more deals in 2025.
So they're essentially selling access to their vast academic content library for AI companies to train their models.
It certainly looks that way. It really shows the hidden, or maybe not so hidden, value in these large specialist data sets in the age of AI.
Fascinating. Okay, so events are strong, academic markets are strong, but there was one area that sounded a bit trickier. Informa TechTarget.
Yes, Informa TechTarget. This is the division formed by combining Informa Tech's digital businesses with TechTarget back in December 2024. They're calling 2025 the foundation year.
Foundation year often sounds like code for things are a bit rough right now.
Well, they did face a subdued market, as they put it. Underlying revenues actually declined by 4.3% in the first half.
A decline. Okay, that stands out against the other divisions. But wasn't there something even bigger? Didn't the whole group report a loss?
Yes, you're right to pick up on that. This is probably the most complex bit in the results. The entire Informa group reported a statutory operating loss of £137 million for the first half.
A loss. After all that talk of 20% plus growth in profits, how does that work?
Okay, stick with me here. The report clarifies this loss was primarily driven by a non-cash impairment of goodwill in Informa TechTarget, a very large one, $484.2 million.
Right. Non-cash impairment of goodwill. Can you break that down? What exactly is goodwill and why was it impaired by nearly £500 million?
Sure. So goodwill, in accounting terms, is basically the premium a company pays when it buys another company, above the value of its tangible assets like buildings or equipment. It represents things like brand reputation, customer relationships, intangible stuff.
Okay, the fuzzy value stuff.
Kind of. And an impairment means the company has reassessed the value of that acquired business and decided the goodwill isn't worth as much as they previously recorded on their books. It's non-cash because money isn't actually leaving the company right now. It's an accounting adjustment, reducing the asset's value on the balance sheet.
Got it. So why do they write down the value of Informa TechTarget's goodwill so drastically?
Two main reasons cited. First, the market capitalization, the stock market value of Informa TechTarget fell below its net asset value. Second, there was that revenue decline in the first half.
And they also mentioned something about customer spending.
Yes. Crucially, they noted that enterprise technology customers continuing to prioritize AI-related research and development over investment in product marketing and sales support. That directly impacts TechTarget's business model, which relies on that marketing spend.
Okay. So the market conditions specifically hit that division, leading to the write-down, which then dragged the whole group into a statutory loss on paper, even though the other divisions were profitable.
Exactly. That's why it's so important to look beyond the headline statutory number. The adjusted operating profit for the group, which excludes things like this impairment, was still up strongly, as we discussed earlier.
That clarifies things a lot.
Yeah.
So what's the outlook for TechTarget now? Are they just writing it off?
No, not at all. Despite the tough first half and the impairment, they're still guiding for broadly flat revenues for the full year 2025 for TechTarget.
Flat. So they expect things to pick up significantly in the second half.
That seems to be the implication. They're likely focused on integrating the businesses and hoping the market dynamics improve, or maybe their combined offering starts to gain more traction. It's definitely the division under the most pressure right now, though.
Okay, that makes sense. A complex picture, but the distinction between the accounting loss and the underlying operational performance is key. So with these different divisional stories, how is Informa planning to tie it all together and keep the momentum going? They mentioned this One Informa program.
Yes, the One Informa program. It's their 4-year strategic plan running from 2025 to 2028. Think of it as their blueprint for maximizing growth across the whole company.
What are the main pillars of this plan?
First off, focusing on their market-leading specialist brands. They have over 800 of these. The plan is to better align them under the main Informa brand to boost their profile. And they want to do more brand syndication.
Syndication. You mean taking a successful event brand, say, from the US and launching it in Asia?
Exactly that. Replicating successful formats in new markets or adjacent sectors. It also involves partnership growth.
Makes sense. Leverage what works. What else?
Deepening their positions in growth markets. We saw that with the live events expansion, but they specifically called out their recent move into luxury and lifestyle through something called Informa Prestige.
Informa Prestige. What's that?
It's a new grouping that includes over 10 really high-value brands. Think Palm Beach Boat Show, Monaco Yacht Show, Art Miami, these kinds of premium events. They reckon it's generating somewhere between $150 million and $200 million in revenue already.
Wow, targeting the luxury end. And what about specific growth geographies?
Yes. Continuing that push into faster-growing regions, we talk about India, Southeast Asia, the Middle East. They specifically mentioned a proposed combination with the Dubai World Trade Center, which sounds like a major strategic move in that region.
Okay, brands, markets, geographies. What else is in the One Informa plan? There was something about AI.
Ah, yes, the AI time dividend. This is really interesting. They're deploying their own proprietary AI agent called Alesia across the whole group.
Their own AI, Alesia. What's it designed to do? Just cut costs.
It's more ambitious than just cost-cutting, it seems. They say Alesia is designed to drive both efficiency and creativity. The idea is to automate tasks, sure, but also to help colleagues generate ideas, analyze trends, maybe even draft content.
So freeing up people's time, this time dividend for higher value work, innovation strategy, that kind of thing.
That's the concept. Reinvesting saved time into growth and innovation. It's a potentially powerful use of AI beyond just automation.
Very forward thinking. Any other key elements?
2 more big ones. Enhancing marketing effectiveness by embedding something called the Iris Customer Data Platform across the group.
Iris. Sounds like another internal system.
Pretty much. Think of it as their central brain for understanding customers. It helps them target marketing better, personalize experiences, and really leverage that first-party data we talked about earlier.
Right, connecting all the dots on customer interactions.
Exactly. And finally, focusing on enhanced customer experience, especially for the live B2B events, adding more services, making it easier to buy tickets or book stands, and general operating effectiveness. Basically simplifying the business using technology to boost long-term profitability.
Okay, so it's a pretty comprehensive plan. Branding, expansion, AI, data, customer experience, efficiency, covering a lot of bases.
It definitely looks like a well-thought-out strategy to build on their current strengths.
So with this strategy in place and the strong financials we discussed, what does it all mean for shareholders? Are they seeing the benefits?
Informa definitely emphasizes their commitment to shareholder returns, and the numbers back it up.
How so? Dividends.
Yes, they talk about progressive dividends. The interim dividend for 2025 was increased by 9.4% to 7.0 pence per share. Consistent growth there.
And buybacks. I remember seeing something about that.
A lot about that. They've got a very significant share buyback program running. They'd already bought back $200 million worth of shares this year up to the report date.
Okay.
And they committed to buying back another $150 million in the second half of 2025. So that's $350 million total for this year alone.
$350 million in 1 year. That's substantial.
It really is. And they pointed out that since 2022, they've returned over 1.8 billion to shareholders through buybacks. It's a strong signal of financial health and confidence.
And this is all supported by a strong balance sheet, presumably. They have the cash and financial stability to do this.
Absolutely. Their balance sheet looks robust. They recently issued a 700 million bond in June, which helped extend their average debt maturity out to 4.5 years. That gives them breathing room.
And liquidity, cash on hand.
Plenty. At the half-year mark, they had 764.9 million in cash, plus another 1.145 billion in undrawn credit lines they can tap into if needed. So nearly 2 billion pounds in available liquidity.
That's a solid cushion. And didn't you mention something unusual about their debt earlier? Something about covenants?
Yes, this is quite noteworthy. The report states the group has no financial covenants on any of its borrowings.
No covenants at all. What does that actually mean in practice? Why is it significant?
It means they don't have strict rules or financial ratios tied to their loans that they must maintain. Often lenders will say your debt to earnings ratio can't go above X, or you must maintain a certain level of profit.
Right, those hurdles companies sometimes struggle to meet in tough times.
Exactly. Having no covenants gives Informist enormous financial flexibility. They can pursue strategic opportunities, manage through downturns, or invest heavily without worrying about tripping these specific debt conditions. It's a real position of strength.
That is significant flexibility. One last financial point: currency. They're global, so exchange rates must matter.
They do. About 62% of their revenue and 54% of costs are in US dollars or currencies pegged to the dollar. They estimate that every 1 cent movement in the US dollar to British pound exchange rate impacts their annual revenue by about 18 million and adjusted operating profit by about 7 million pounds.
So something they definitely have to watch and manage.
For sure. It's just part of being a large international business.
Okay, so strong financials, strong shareholder returns, lots of flexibility.
Yeah.
But no company operates without risks. How is Informa thinking about and managing potential threats?
They have what sounds like a pretty comprehensive risk management framework. They say it's championed by senior leadership and embedded at every level, which is what you'd hope to hear.
Any specific risks they highlighted or changes in how they view risk?
One interesting change was how they define a particular risk. What used to be called privacy regulation risk has been redefined as failure to use data and AI technologies responsibly.
Ah, that's more than just GDPR compliance then. It sounds broader, more ethical.
Exactly. It reflects those evolving expectations around not just can you use data and AI, but should you, and how do you do it responsibly? It's a subtle but important shift in framing.
That is interesting. Any other risks moving up the agenda?
They noted a moderate increase in the likelihood of the risk related to reliance on key partnerships, which makes sense given the big TechTarget combination and the proposed venture with the Dubai World Trade Center. More reliance on partners means more potential points of failure if those partnerships sour.
Makes sense. And what about AI itself? Is that seen as a major new risk category?
Not exactly as a standalone category. They seem to be integrating AI risks and opportunities into their existing principal risk categories.
Which is?
Things like market risk, how AI changes customer behavior, technology failure, risks of AI systems going wrong, data loss, cyber breach, AI adds new dimensions here, and even inability to attract and retain key talent, needing AI skills.
So they see AI affecting everything rather than being its own isolated problem.
That appears to be the approach. It's woven into the fabric of their existing risks, which feels like a mature way to look at it.
Okay, so they're actively managing these risks. But this leads to a really fundamental question, especially for a company involved in large events. How do they know they can actually keep operating if something really bad happens? Another pandemic, a huge recession. What's the process for assessing that?
That's the going concern assessment. It's a formal process the directors have to undertake to confirm they believe the company has the resources to continue operating for at least the next 12 months from the reporting date.
And how do they test that? Do they just cross their fingers?
No, it's much more rigorous than that. They use detailed financial modeling. They run their forecasts under different scenarios, a base case with sensitivities looking at moderate impacts.
Okay.
But they also do something called a reverse stress test.
Reverse stress test. What on earth is that?
It's basically where you push the model to its breaking point. You ask, what scenario, how bad would things have to get before we couldn't meet our financial obligations? You work backwards to find the failure point.
Wow. Okay, so what kind of extreme scenarios did they model for this assessment?
They looked at some pretty severe but unfortunately plausible ones based on recent history. One was a pandemic risk scenario.
Oh boy, what did that involve?
No events trading at all from August to December 2025. Then a really slow recovery events, only getting back to 75% of normal revenue in the first half of 2026, then 90% in the second half. Pretty drastic.
That sounds grim. Any others?
They also modeled a market economic risk scenario, basically a recession hitting in the second half of 2025, significantly reducing event revenues and leading to sluggish growth afterwards.
Okay, so they threw the kitchen sink at the model. What was the outcome? Could they withstand that?
Impressively, yes. Even under the combined impact of these severe scenarios, the modeling showed the group would still maintain a minimum liquidity, headroom, cash, and available credit of more than 600 million.
600 million headroom, even if events stopped completely for months and a recession hit.
That's what their modeling indicated. And the reverse stress test. It suggested that Informa could withstand losing 41%, nearly half, of its forecasted revenue from August 2025 all the way to the end of 2026, and still maintain positive liquidity.
41% of revenue vanishing, and they still stay afloat.
Yes, and that calculation even assumed they took no mitigating actions like cutting costs, and that they refunded customers for canceled events. So it's a truly severe stress test.
That's actually incredible resilience. It paints a picture of a very financially robust company.
It certainly does. Based on all this, the directors concluded, quite confidently it seems, that the group has adequate resources to continue operating for the foreseeable future.
Right. Okay, so let's try and pull all these threads together then. We've seen Informa delivering really strong half-year results overall for 2025.
Yep. Impressive growth in revenue, profit, earnings, cash flow, especially on that reported level, but solid underlying growth too.
Driven mainly by the booming live B2B events and the steady high-value academic markets division, which is also cleverly leveraging its data for AI licensing.
Correct. Offsetting that, though, was the clear challenge in the Informa TechTarget division, grappling with a tough market and leading to that significant but non-cash goodwill impairment.
Which dragged down the statutory profit, but the adjusted profit remained strong. And they have this One Informa strategic plan aimed at driving future growth through branding, market expansion, AI, data, and efficiency.
Backed by a very strong balance sheet, significant shareholder returns through dividends and buybacks, and that crucial financial flexibility from having no debt covenants.
And finally, a robust approach to risk management, including stress tests that show remarkable resilience even under pretty dire scenarios.
It really depicts a company that's performing well, has a clear plan, and seems well fortified against potential shocks, despite the specific issues in one division.
So, stepping back, what does this deep dive into Informa tell us, maybe more broadly, about the future, especially for these kinds of B2B information and event businesses?
Well, I think Informa's heavy emphasis on first-party data is key. It's clearly a massive asset, and their aggressive move into AI, not just for efficiency, but explicitly for creativity with tools like Alesia, that feels significant.
Right. It's not just about automating the old ways, but potentially enabling new forms of content, new event experiences, new research insights.
Exactly. And combine that with their focus on responsible data use, managing those AI risks. It suggests the future value in these markets lies increasingly in owning unique, specialized data and deploying intelligent technology thoughtfully.
So here's a final thought for you to ponder. How might other industries, maybe even your own, start following a similar path? How could they leverage their unique data assets, perhaps even develop proprietary AI like Alesia, to transform their own business models, moving beyond just efficiency gains?
Yeah, could Informa's playbook become a template for others trying to navigate the shift from traditional B2B operations to a more data-driven, AI-enhanced future? Something definitely worth thinking about.